Welcome to another H-Law masterclass. This one is on convertible loans, ASAs and SAFEs, two very well-known acronyms that we'll get into during this session. My name's Henry Humphreys. I'm the managing partner of Humphreys Law. Firstly, just a bit about us. We're a full-service for tech law firm. We spend a lot of time advising on VC investments of all different kinds, mergers and acquisitions, largely private M&A, but all sorts of different types of M&A deals. We do a lot of funds and fund formation work, putting together GP, LP type structures for fund managers of different kinds, lots of UK onshore fund managers, but fund managers in other places as well. We do a lot of debt finance work of all different kinds. We've got a tremendous tax team here who do tax on M&A deals and also tax when it comes to things like employee incentives. We have a tremendous IP team. We do a lot of work in data protection, and for fintechs in particular, we have a team that does fintech regulatory. We're ranked in the Legal 500, which is always nice. We appear pretty regularly in the PitchBook league tables for European VC lawyers. We were up for a couple of awards this year. We're about 30 people, getting on for 20 lawyers, and we've got offices in those places there, head offices in London, also people elsewhere. But there we go. Bit of a disclaimer before we get going. For obvious reasons, nothing in this presentation amounts to legal, tax, or regulatory advice. Nothing we say now should be relied upon. Always take your own advice. Much of what I say now over the course of the next 45 minutes to an hour will probably go out of date one day. It almost certainly will in many cases. And obviously nothing I'm about to say will have been tailored to your own circumstances or the circumstances of any particular transaction, and we may or may not make these slides available afterwards, but if we do, please don't publish them online, and obviously it's H-Law IP and everything else. So there we go. Raising finance. Those in the venture tech scene think about the ubiquitous venture capital as being the fuel for raising money for tech companies. But venture capital is just one way to fund a business. It is perhaps and has been the optimum way of funding fast growth venture tech type businesses that take a lot of capital to get to scale and to become profitable and everything else. But outside of that, it may not be the best way of funding a business. So if you are raising capital, you always think about personal funds, savings, grant funding, bank loans, working capital from trading and everything else. But just say that at the beginning, because it's easy to forget that venture capital is just one way of raising capital for businesses. To understand venture capital and convertible deals, you first have to understand what a VC priced round or a priced deal actually is. For many of those on the call, this will be teaching you to suck eggs, but we'll just go through very quickly. So VC funding typically sees investors deploying capital into companies in rounds or series of equity finances. These are priced deals because each time there is a funding round of that kind, there is a price agreed for the entire issued share capital and the wider fully diluted share capital of the investee company, and a valuation is set. Price rounds are not always possible or suitable. They can take a long time, documents heavy. They're therefore costly in terms of legal costs, that is. They need a price to be set. We'll come to that in a bit more detail in a bit. And they also normally require the whole round to be closed out all at the same time, all at once. There are exceptions to that, and you can have tranched deals or deals with milestones and things like that. But generally speaking, it's a question of bringing everybody together to sign all the documents at once, all at the same time. There's a bit of a busy slide there, which is a diagram of what a priced rounds might include if you just work from left to right very quickly. This is one way of looking at it. If you have a new deal in from a law firm's perspective, you need to get engaged, you need to sort KYC out, and then you need a cap table in Excel. That needs to go through into a term sheet and maybe a completion agenda put together. You're going to need to think about some self-certification forms for FISMA purposes and also for AML purposes, investor KYC. Those are at the top. And then if you've got a term sheet and a cap table, which can obviously take quite a long time to agree, and the pricing bit of the priced round goes into that cap table, by the way. But if you've got those things, then you can get into looking at the long form documents, which are in this column here in the middle in orange. And the principal long form documents there are the Articles of Association, which is the key constitutional document for the company, which is a contract between the company and its shareholders, and amongst other things has the rights attaching to the shares in it, the shares to be issued. You then have a shareholders agreement, which is an agreement between the shareholders to which the company is also usually a party. It's not technically part of the company's constitution and typically has in it the personal rights enjoyed by the parties, so things like information rights, consent rights, confidentiality, board appointment rights, things like that. Typically on a price round, you're going to have warranties given, a full suite of business warranties, and that those will be put into a subscription agreement, which you've got at the bottom there. Those warranties could be at a minimum 6, 7, 8 pages, something like that, of contractual promises about the business and status of the company. Because you have those warranties, you then need a disclosure letter, which is the agreement or the document above there. The disclosure letter on UK deals sets out the exceptions to and the qualifications of the warranties in the subscription agreements. And then at the top there, you've got service agreements. So typically, particularly on sort of Series A type deals, doing a price round of that kind may see service agreements put in place for the founders, if not also key management. To the right there in the blue, you've then got a whole long list of ancillary documents that need to be signed up at the same time: shareholders' resolutions, board minutes, APO1 forms, Section 431 elections, SHO1, share certificates, all that kind of stuff. And then you've got to go and get the stuff signed up and do various things post-completion, including filing stuff at Companies House. So I've put that there because if we go back to the previous slide, which is that one of the disadvantages of priced rounds is that they can take a long time, they're document heavy, they can therefore be expensive from a legal cost perspective. They require that price to be set, and then the whole thing, certainly for first close, has to be closed out all at once, all at the same time. And you could probably see, if you go back and look at this diagram, that is a potentially complicated, involved process. So particularly for early stage deals, and this is very much grown out of the US and US practice, clever people on the founder, investor and legal side have thought of different ways of shortcutting that process in a way that will work commercially. And the traditional way of doing it was with a convertible round. So rather than going through all of that, getting all of that done, the idea was instead that you could put together a convertible round designed for speed and efficiency and therefore lower legal costs. And the idea would be classically, traditionally, that the convertible round would be a bridge to the priced round and provide the company with the funds needed to keep going and wait until a lead investor had been found to do a larger priced round, which would look a bit like that. So the standard approach was the convertible loan, i.e. a loan which is a debt owing by the investee company to the investor, and that sits on the balance sheet as a liability, therefore, but a loan that can convert into equity, i.e., shares in the UK or stock in the US, and the funds are then invested as a debt in advance of the next funding rounds to then convert into equity, ideally at a discount. Now, there's two ways of doing that on UK deals. You can use what's called a CLA or a CLNI. A CLA is a convertible loan agreement, and a CLNI is a convertible loan note instrument. A convertible loan agreement is a bilateral agreement between the investee company and the investor. And a CLNI, a convertible loan note instrument, is perhaps a more sophisticated thing where you have a document executed as a deed poll, which is a special form of or a document with the legal status in the UK. It's not actually technically a contract, but it can be used to form contractual obligations. And a deed poll or a CLNI executed as a deed poll has within it a mechanism for issuing certificates in line with investments, and we'll come to that in a bit more detail in a bit. So in basic terms, when we say a CLA is bilateral, I mean that's what it means. You've got the investee company on the one side and the investor on the other. The investor puts its cash in as a loan, which is convertible at a later stage into equity or is repayable or redeemable in accordance with its terms. A CLNI is more sophisticated. It looks like this. The investee company executes a convertible loan instrument as a deed poll, and then in line with investments, certificates can then be issued to investors there. And you can probably see there already that one of the advantages of doing that is you then have all the investors on the same terms as the deed poll. And we'll come to that in a minute. And you might think, well, why bother? Why not just have lots of CLAs? Well, you can, and it may end up looking like that. And you could have lots of CLAs. You know, if you've got 5 investors, 3 investors, 10 investors, 20, you could have a separate agreement for them all. But there are some significant disadvantages of risks anyway in doing that. One is just general complexity, legal costs, and everything else. One of the advantages of a convertible loan note instrument is you just have one core document, which is this deed poll here, and then the certificates being issued are just one page, and they themselves are executed as deed polls. So you have real efficiency there in terms of the paperwork and everything else. It's very clear that everybody is on the same terms, absent doing any side deals or having side letters with these investors on the right-hand side. A big danger with CLAs is that you have these separate bilateral agreements, but they all end up being on slightly different terms. And we see this a lot, typically where clients come to us having already done this sort of thing, or sometimes we're acting for investors or even buyers of companies. And historically, the companies have been doing this. And then in due diligence, we then have to go and actually look at these things. And if you've got a whole bunch of CLAs all on different terms and saying different things in different styles and different ways, then it's probably fairly easy to realize that that is, if nothing else, a slightly nightmarish thing to start reading into. But worse than that, or more than that, you have very real risks of potential conflicts between what those agreements actually say. And this is where, if you've heard the term MFN, most favored nation, this is where smart investors who invest, particularly under bilateral arrangements of this kind. The risk from the investor's perspective here is that you invest, but the company then goes off and does a whole load of other deals of this kind. So the sophisticated investor here who's gone in for the first one would ask for an MFN in their own CLA. And what an MFN says is that to the extent the company goes off and does the same or similar deals with other investors that are on more favorable terms, which may be what's happened here with the first investor at the top and then 4 investors to follow, then the original investment with the investor who asks for the MFN will be automatically updated effectively to reflect those more favorable terms that are subsequently issued or granted to those other investors. So that is an MFN. So if you've got the choice as an issuing company, ideally, if you've got lots of different investors and you want to do an iterative close over a period of time, then your starting position is probably to use a convertible loan as instrument and to do it as a deed poll, not least so you can try and get everybody on the same terms. And if you're the lead investor, the first one going in here on the right-hand side, then you probably want the same thing because it's an easier way of avoiding a conflict of terms that you might have here, and probably an easier way to make your MFN work. You could still very well ask for an MFN in the deed poll, but it's just easier to administer in this sort of structure. So there we go. We've been doing lots of deals of that kind recently. Obviously, there's been quite a turbulent time in the technology markets. The number of priced rounds has very much reduced. The rounds that are going ahead are at lower valuations, but by and large, outside of a few hotspots, the ubiquitous AI being one of them. And so we are seeing a lot of bridge rounds structured in this way and in other ways. So an example term sheet for a convertible loan note instrument is there to the right. It's just an image there from our precedent. Perhaps surprisingly, for priced rounds in the UK, you have the British Venture Capitalist Association standard documents, and you have a fairly well-worn and well-established set of norms and market practice for priced rounds and for what the documents say in those priced rounds. If we just go back up to the wireframe there for a priced rounds, there are BVCA standard documents for articles, the shareholders agreement and the subscription agreement, and also for the term sheet, although that's in the process of being updated by the BVCA. These are really recently updated, by the way. So there is a well-worn set of norms and market practice for those. When it comes to convertibles, actually much less so. There isn't a BVCA standard term sheet. I'm actually not aware of any standard term sheets at all. And in fact, many deals start off without a term sheet at all. People just present their standard form document. Our house style would always be to start with a precedent, with the term sheet even though the terms may be fairly simple. It's always a good idea on both sides to start off with a term sheet so that you know what you're getting into and how the terms work. Key terms that you'll see in a convertible loan term sheet, and there are some key ones to the right there. These are by no means all of them, but here are some key ones. Typically, they fall into 2 principal groups, 2 principal pots of types of terms. You have the terms that apply to the debt side of it, and you have the terms that apply to the equity side of it. So on the debt side, as I mentioned at the beginning, the investment starts off as a loan, so it's on the company's balance sheet as a liability. Typically, you would agree an interest rate that would apply to the loan. You don't have to have an interest rate, but typically you would. Interest rates were very low for a long period of time. Famously, they've now gone up. And it went up yesterday again in the UK. Bank of England just put the base rate up to 5%, and the cost of money generally has gone up to a price that we really haven't seen for many years. Some of the convertible deals, bridge deals we've done recently have seen the companies who are raising the capital in difficulties as regards their own cash flow, and they've had to accept fairly eye-watering terms, and one of the terms that has been slightly eye-watering is the level of interest. What happens to the interest is interesting. It typically follows the principal sum, in that if the principal sum is to be repaid or redeemed, then it will be the interest will be repaid in cash along with it. But if the principal sum is to be converted into equity, then the interest would follow the principal sum and be converted into equity as well. So when interest rates are very low, then this was a fairly marginal uptick when it came to conversion or redemption. With interest rates now being higher, it's actually something to focus on probably in more detail. And as I say, some of the deals we've done recently have had very high interest rates. One or two of them have had compound interest as well, which is pretty punitive and needs to be modelled out. We closed one recently which had interest compounding quarterly. This is a feature of the market at the moment, with capital in shorter supply and being more expensive generally. My tax team will kick me if I don't mention withholding tax. Withholding tax applies or can apply to interest, typically at 20%. It may or may not apply depending on the terms of the loan and when the interest is actually payable. As far as I understand it, if the loan is less than a year, then it may not apply. More than a year, and it may well do, but you want your convertible loan note instruments or your loan documentation anyway to deal with withholding tax, because from a company's perspective in particular, you want to be able to withhold that tax and account for it, and therefore net that off effectively when it comes to repayment or conversion. That's enough about interests. Maturity date, so that's when the loan would be repayable, and again, it may be repayable or convertible, but typically you want a maturity date in there. Remember, with convertibles, you're typically designing them as a bridge to the next funding round. So the maturity date is usually a long stop date, which is far enough out into the future so that the Series A, which is being built toward or planned, should have completed before then. So if you were doing a bridge round now to get you through to a Series A in, say, 18 months or a year, something like that, then the maturity date could be 2 years, say. You don't see much longer than 3 years. There was the Future Fund the UK government put together during the COVID epidemic, which funded companies using convertible loans. Those loans had maturity dates of 3 years in there. That's about the longest you'll see. Be careful choosing maturity date that's too short. In the example I gave there, which is you're doing a bridge raise now to try and raise a Series A in say a year or whatever. Well, if you select a maturity date there of a year, that leaves zero room for slippage and everything else, and a lot can happen between now and closing any funding rounds, as a lot of companies have found out in the last 18 months or so. So there we go. There'll be various other circumstances where the loan will be repaid, and these are the classic sort of circumstances that you'd see in any debt facility agreements, typically around events of default, so insolvency type events, breach of the agreement, that sort of thing. Convertible loans are typically not secured. Occasionally you see arrangements where they are secured, but if we go back again to the principal rationale for doing a convertible deal, which is speed, simplicity and low cost, you can probably see that securing the loan against the assets of the company is something that is going to make it more complicated, more document heavy and more costly. So that's normally a very good reason not to do it on the company side, if not also the investor side. And then also, if you are securing the loan, then that gives you a great deal more protection on the downside if you are an investor. And so, on what basis then are you asking for the same set of equity rights? So, in general terms, you don't see them. Occasionally, have seen them. If the investor will not do it unless it is secured and the company has to raise the money, well, you can do it, and it is possible to do them. The other point with security is that if the loan is converted into equity, then the security needs to be released, and the conversion could happen fairly quickly. So you could end up putting a lot of work into doing the securing, and then have to undo all that work fairly quickly thereafter. So there we go. So those are the key debt terms, and then you turn to the equity, which is when the loan converts into equity. So you need to understand when the loan is going to convert. So again, typically, classically, you put together a convertible round as a bridge to a Series A financing. So traditionally, classically, the way it works is you set a lowest threshold for the amount of capital to be raised on that round. So that could be, I don't know, 5 million, 10 million, 1 million, whatever it is. But you define that as a qualifying fundraise or a qualified fundraise or whatever you want to call it. And then the loan would automatically convert if that fundraise takes place. But there are various other circumstances of conversion usually as well. Usually the investor would want the option but not the obligation, or the right but not the obligation, to convert on a funding round that was below the threshold. So if you set the threshold at 5 mil, if you do a funding round at 10, then the loan will automatically convert. But if you did a round and raise 4, then the investor would have the choice of whether to convert or whether to keep the investment as a loan. You also need to build in functionality for what happens if the company gets bought out. So if there's an exit, a share sale, asset sale, IPO, those are the 3 classic forms of exit on venture deals. And typically the investor would have the option or the right, but not the obligation, to convert in those circumstances. And the rational investor would look at the valuation of the exit and choose between conversion and redemption, whichever delivered the greater return to it. If you're interested or have done convertible deals, you'll have heard about the percentage discount. So the way in which discounts work, or the reason why the discount is there, is if you think back to the rationale for doing a bridge, which is to put the money in early, fund the company through to a priced round, and then convert on that price round and do your price round and order documents at that stage in time. Well, from an investor's point of view, why would you do that? Well, one of the reasons why you do that classically is you get a discount on the price per share on the funding round that triggers conversion. So if we go back up here to your price round documents, you can see here there's a cap table that would get agreed in Excel. That cap table will have a valuation in it that will pre-money valuation that will be divided by the fully diluted share capital immediately before completion, and that will give a price per share. And the investors that are coming in on this price rounds, they will invest at that price per share and be issued with their shares as part of that price round. With convertibles, I've lost my place here. With convertibles, you don't have a price per share until conversion happens. But when conversion does happen, you have a price per share. And typically you would then take a discount to that price per share, which rewards you for having put the money in early. And that discount could be anything. There's no legal rules around what it could be. It could be anything. But typically you'd see anywhere between 10% and 30%. More than 30% starts to become a little eye-watering. Less than 10% starts to become a bit difficult in terms of why would you do it in the first place. Again, the market standard for discount moves up and down depending on market conditions and supply of capital in the market generally, and so on. These are all commercial points to be agreed between investors and the investee company. If we go up again to the depol point, so you can probably start seeing where if you do a convertible loan note rounds, all these terms would be set out in your depol, in your convertible loan note instrument, and you wouldn't then need to worry as an investor between whether or not different deals have been done between different people. You can probably start to see that if you had an arrangement like this and you're one of these investors on the right hand side, you might worry that different investors have been different discounts have been given to different people. So this person at the top might have 10. A deal might be done 6 months later when the company was in a worse position, and the discount here might be 30, and another deal might be done when the company was completely strapped and absolutely desperate, and there could be a discount here of 50%. And you can probably see that this person here would then have a much, much better deal than this person at the top, unless they'd agreed an MFN, the most favoured nation clause here, in which case, every time a greater discount had been done through, their convertible loan agreement would be or should be automatically updating. So there's the discounts. When it comes to that example of putting your money in early and taking a discount, famously, particularly driven by the US, there's some edge cases where, from an investor's point of view, this would still actually not end up being a tremendous deal. And that's particularly the case where you put your money in early into the company, and the company then has extraordinary success incredibly quickly, and then does the priced round at an absolutely ginormous valuation. So you could see these examples, particularly in life sciences, perhaps, where companies are going through rounds of clinical trials and looking for regulatory consent of various kinds. You can see it in fintech as well, quite often. But you get these hockey stick style upticks in valuations, and you can probably see there that if when you put your loan in, the company was even at the upper end, say worth 10 million, something like that, and you agreed, say, a 20% discount. If when the time came, the company was actually valued, and remember the valuation is being done up here by the lead investor on the priced round in this cap table. So if when the time comes, that valuation is being done there and the valuation is, say, 100 mil, then you probably wished, even with your 20% discount, that instead of writing a convertible loan, you just took some priced equity back when the time came. So clever investors, clever lawyers, clever people generally then thought of a price cap. So price cap typically works instead of the discount. And what the price cap is a worst case from the investor's point of view, best case from the company's point of view, valuation for the next funding round. So in the example I gave, you invest now with a 20% discount, but you might say that the absolute cap from an investor's point of view that they're willing to agree to could be, say, 50 million. And what that then means is if your priced round comes in and at 100, say, then instead of taking the 100 for the purposes of converting the loan, you would instead take the 50. So that's what the cap does. We could talk in a lot more detail and write some examples of that, but that will be for another day. MFNs, another point, but I've mentioned those already. So the most favoured nation clause. Most favoured nation clause look to automatically update those terms above if more favourable terms are given to other investors in the future going forward. As an investor, if you've got the leverage, you probably always ask for one if you could get it. And then you may want warranties as an investor. You may want some simple warranties from the investor if you're the company, particularly around AML and source of funds and that sort of thing. With convertible loans, even if you do get warranties, you want to try and avoid giving a full set of business warranties that you would see on a priced round. Remember, if we go out to our little diagram here, On a priced round, you'd have 6, 7, 8, 9, 10 pages, maybe more, of warranties in a subscription agreement, and then you would go through those line by line and produce a disclosure letter, usually linking through to a data site that had all of the exceptions and exclusions to the warranties in it. That is a time-consuming process that is potentially expensive to do, and it will be done, or should be done, when it comes to the priced round to come, your qualifying finance, your Series A, whatever it is going to be. So very much ideally, you want to try and avoid duplicating having to do that process now. So typically the warranties given in a convertible loan deal, typically the warranties given in a convertible loan deal are fundamental warranties that shouldn't need to be disclosed against. So that, for instance, the company is not subject to a winding up order. That is a binary question, yay or nay, against which you shouldn't need to be disclosing. You might want to set a warranty for an investor as regards the lack of material litigation, setting a fairly high threshold for that so that you then don't trigger a big disclosure exercise. Those sorts of things. Next slide is there's just a page there. That's the beginning of our precedent convertible loan note instrument. I put it up there because later on we're just going to quickly talk about safes, and if you just take a mental note there of the style of drafting and just what it looks like on a macro deal, you can say that this is a typical English law style of drafting, particularly with the use of definitions at the beginning of the agreement. One key thing here at the top is that you'll see there's only one party. So you've got the date there and it says made by, and you've got the investee company. So the reason for that is again, this is a deed poll rather than a bilateral contract. Okay, ASAs and UK venture capital tax reliefs. So in the UK, we have, as many of you will know, some of the most attractive venture capital tax reliefs anywhere in the world. Principally VCT, EIS, and SEIS. There's also EMI option schemes, which is a topic for another day. Classically, traditionally in the UK, a lot of very early stage investing has been done by angels and even some VC funds using the EIS and SEIS tax reliefs. EIS is Enterprise Investment Scheme. SEIS is Seed Enterprise Investment Scheme. This session is not a summary on what those things do, but in crude and simple terms, for EIS allows UK taxpayers with UK tax liabilities to claim 30% tax relief on funds invested, and with SEIS it's even better at 50%. And then free themselves from capital gains tax on exit, on sale of the underlying shares. So these are tremendous tax breaks and have been a huge part of the UK venture tech story. However, there's always been a problem because they don't qualify, or if they don't work if the investment goes in as a loan. So principally because the loans have to be repaid, they've got interest applying to them. It may have other offending features. So for a long time, it was thought that you couldn't use convertibles at all for early stage UK tech investing if you wanted to benefit from EIS and SEIS relief. 10 years ago or more, the Advanced Subscription Agreement came along as a new bit of a new type of document. And what an advanced subscription agreement is essentially is a convertible loan agreement, but without any of the debt features. So there's no repayment of the principal, no interest, and no other arrangements to be repaying the money. The money going in is not a debt; it's a prepayment. And what it does is gives the investor the right to issue with shares in the future. There were at one stage longer time horizons, but a couple of years ago now, I think HMRC confirmed that they see 6 months as being the appropriate horizon. So ASAs now need to be structured so that the pricing and the issuing of the shares must take place within 6 months of the investment going in, albeit the price can be left to be determined. So again, with an ASA, you'd be looking to determine the circumstances of the issuance of the shares, and these will be the same: qualifying finance round set, giving the obligation on the company to issue the shares automatically, also an exit, also events of default and other things like that. And then again, you would go back to do your priced rounds and convert, and it would look something like that. I would say with ASAs, they do seem to have a narrow range of use cases, principally because they do have that 6-month time horizon. There's an argument to say that if you've only got 6 months to plan your priced funding round, then why not just do the priced funding round now? It also leaves you a little bit as a hostage to fortune in terms of being able to actually do that funding round. You may not be able to do it, and yet you'll still have to issue the shares, which could leave you in a scenario where you have to go through this process and this level of documentation potentially, but without any new money coming in, and then having to redo the whole thing anyway when you eventually get to do your Series A in due course. So again, it's a nice acronym. It sounds clever. If you are trying to raise money through ASAs, I would just remember that 6-month time horizon and think about whether it may just be better just to do a price round immediately, or to do it in some different way. And just to finish off, SAFEs, which are very well known acronym, ubiquitous in VC terminology in the US, and increasingly well known in the UK. SAFE means Simple Agreement for Future Equity. It's not a legal term for sure. It's actually a marketing term. I believe it was invented by an in-house counsel at Y Combinator in 2013. Probably know Y Combinator is probably the most famous accelerator incubator worldwide, and based in the US, and has a very fine track record of producing household name tech companies from its incubation system, including Airbnb and various others. The SAFE, as far as I understand it, was put together by Y Combinator to try and move away from traditional convertibles for very early stage companies and to make them more like equity securities. But again, it's not an English law document. These are US documents, US terms, US shares. If you try and use them for a UK deal, you'll be putting a square peg into a round hole. If you go to the Y Combinator website, you can go and find the documents. They're up there for free. They've got their US documents there, and you can see they've got different variations of them. They've got the cap, but with no discounts. They've got the no valuation cap. They've got an MFN no valuation cap and no discounts. I don't actually know why they have done it in that way and not just built the functionality into the same documents, but US documents, US terms. I don't know. This is what the US. This is what the SAFE looks like, downloaded from their website. You can see it looks very traditionally US in style. You can see it's a bilateral agreement at the top here between the investor and the company, and you can see the US style, which is not to use definitions at the start and to have enormously long paragraphs, which are quite hard to understand. But there we go. So there we go. I think I've managed to finish exactly on time. So